Hello and welcome to TaxSnax. This episode is concerned with the changes to pensions in the latest finance bill, as well as the government's autumn budget. My name is Patrick Boch, and I'm a barrister at All Square Tax Chambers. Now, the changes to pension taxation in the current tax bill are quite benign and not particularly interesting. Clauses 32 to 34 of the draft legislation provide effectively that the exemption under Section 244C Finance Act 2004 for transfers of pensions between EEA member states and the UK is abolished, so that unless another exemption applies, there is a 25% charge. B, if you transfer your pension to another member state, then there are now requirements about it being regulated in the other member state in a broadly similar way to the UK. And then finally, there is now a requirement that the scheme administrator of a pension be UK resident. So none of that, I think, is particularly exciting. It's simply it's simply implementing an element of Brexit, if you like. The more interesting announcement is this, and I'm just going to read from the government's autumn budget. It is as follows. It says, this is 2.4 as it's set out on gov.uk, and it says, inheritance tax, unused pension funds and death benefits. As announced in the autumn budget, the government will bring unused pension funds and death benefits payable from a pension into a person's estate for inheritance tax purposes from 6th April 2027. As part of these changes, scheme administrators will have to report and pay IHT and so forth. Now, this is kind of interesting, but also a bit perplexing. And the reason for that is simply that at the moment, in the vast majority of cases, the person who receives death benefits under a pension is subject to income tax on those benefits. So if one of your relatives dies and you are to receive the remainder of the pension, then there would usually be an income tax charge on that. There are some exceptions to that, but these are quite narrow and not very common. I'll just mention two of them. One is if your personal representatives, so for example, your executor, is entitled to receive the pension. In such a case, it's considered to be part of the death estate. And you can see the logic of that, because if it forms part, if the personal representative is entitled to receive it, and if there isn't an income tax charge, then it's fair enough that it be subject to inheritance tax. In the same way, if the deceased had an annuity or some other right guaranteed for a period of time to receive funds, then that also is part of the death estate. But in circumstances where your relative receives a payment and pays income tax, I really wonder what it is the government is envisaging. Is it suggested that there should be a double tax charge, one to income tax and one to inheritance tax? Is it suggesting, in which case that would be grossly unfair? Is it suggesting that the income tax charge be removed, so that instead of paying tax at your marginal rate, you're going to pay effectively a 40% inheritance tax charge? For a lot of taxpayers, that really wouldn't make much of a difference. And so, unfortunately, all I can say is this announcement, to me at least, looks mystifying. Thank you.